folks, we've got a confirmed three-peat on our hands, and I've got to say it again, the sellers must be absolutely livid with today's price action. Although this time around, Michael Burry is still on Twitter, but we'll see how long that one lasts. This, of course, is a prelude to the Midweek Market update video, which will still come out tomorrow, but let's dive into the charts and evaluate, so to speak, the quote-unquote damage after today's performance from Jerome Powell. The damage, of course, is in reference to anyone's account who is short this current market. Anyways, what do we see on the daily time frame chart? Certainly a solid close up towards the highs of today's trading range, which no matter what side of the trade you fall on, you can't really ignore that as a bullish indication. In terms of context, on the daily time frame chart, we are back above the double top from here, which we also know to be the weekly pivot that we needed to close above for the weekly higher high. That number was SPY 410. The close above also strikes me as being clearly more bullish than bearish. The last daily context piece that I would point out is that we've also closed back inside of the in and out bar from last Friday. If sellers were going to be making progress for some sort of meaningful market pullback here, we should have spent more time underneath Friday's lows and not accepted back in Friday's range. So because that did not happen, once again, this does stack up as being more of a bullish than bearish data point. Let's have a look at our hourly time frame chart. And I want to specifically illustrate two clear examples of failures from the sellers. Number one is that on Monday, we open on a gap down, which instantly puts the context for the day in favor of the bears. We should close the gap above and then reverse off of it. That's the gap fill reversal that we're always looking for, and that's exactly what happened. So far, so good. We even start looking into the single prints from the FOMC rally of last Wednesday. But notice that there's absolutely no follow-through from the sellers when we move into that area. Remember that we treat this as if it were a gap. Very, very thin structure there, not a whole lot of volume committed. Therefore, the market should move through it with relative ease if some certain side of the trade is going to have strength. In this case, because it's from the top down, the sellers should have some strength there. It's simply not the case. Now, don't get me wrong, on Monday, we spent all of the day's trading range underneath Friday's session, so the dream lives on for Tuesday. Now, Tuesday, we open up and we push back underneath the single print, but we don't actually take out the low of day from Monday here, so no problems. However, on the big reversal from Jerome Powell's speech here on this bar, what time frame was that? 12:30. On the 12:30 bar, when all of this momentum to the upside reverses in the downward direction and we actually do take out the low of Monday, notice that little lower wick here, there's zero follow through once again through the thin structure as represented by the single prints. If the sellers were going to do something impressive, they should have closed that, no doubt about it, on the momentum from that sell side move. It simply did not happen. There's no evidence here of stronger sellers entering the market on an OTF timeframe. Other timeframe traders, larger traders who would look to position short for, say, 3 months, 6 months, 9 months, positional type traders. This is just algorithmic nonsense and volatility going on here. Nobody wants to be short this market. So knowing that, how did we close? Once again, we completely take out the upper wick from here where the sellers initiated, be it, algorithmic selling or not. We take that upper wick out and close right on the level. So once again, more of a bullish indication here as opposed to a bearish one. Now, let's not get things twisted. We're not expecting that the market breaks out of this prior high here. We're not expecting that the market breaks the upper edge of the weekly expected move and goes on to run for another 10 points. I think that the rainbows and butterflies situation that we described in the Sunday night episode for consolidation up here is more likely, and we'll talk about some charts that would indicate still maybe some consolidation, right? So the first of those charts, let's go ahead and have a look at our market internals. Here we can see clear as day on Monday that there was obvious sell side momentum. We're completely stuck down below in trend zone here. And notice in the first, hour and a half or so of the day's session, all of the ticks are negative. So once again, this fact that the sellers have failed to move through those single prints on pretty strong sell side internals does not strike me that, big new money sellers are entering the market. It's just simply not the case. Given all of the evidence and opportunities that the sellers had, there's just, nothing's going on from that perspective. I've been pretty clear about that thus far. Now on today's session, notice the momentum as we start accelerating in the downward direction. I mean, all of these internals are absolutely collapsing. Mega negative tick here. Making a move down to negative 1,500. That's, you rarely get those types of moves. So once again, speaking to momentum, the chance was absolutely there for the sellers to close those single prints today. It just simply didn't happen. Now, once again, the idea is not that we go on to break out of this range and make new highs around the corner. Notice that, sure, we improve back in volume reads, but we don't make it to that positive 300 million mark. We do improve back to above the zero line inside of the advanced decliner, but we're still not up in trend zone. And although the ticks did get some pretty extreme reads here into the close, the cumulative build isn't really all that strong. So at the end of the day, yes, it was a strong reaction, but I don't know about just continuing for big new higher highs, right? Let's continue along through some other evidence, and the market profile is going to be a great look here as well. What I want to point out, and by the way, if you don't know what the market profile is, here's a video in the top right-hand corner as a brief tutorial to get you familiar with some of the terms I'm about to use. Look at the value area. Value area did not shift higher in the profile. Notice that it's kind of anchored, so to speak, down here towards the lows, and it's completely overlapping with the Monday value area, which was right here. Monday was a normal curve, and today is a very elongated profile. So the fact that we couldn't really establish value on one side or another of the Monday value, to me, doesn't really speak to improved bullish odds or continuing this rally by committing a lot of volume up here at the highs. Speaking of committing volume, obviously a clear indication here as well is that the point of control actually migrated lower with price on today's session. You know, all of the acceptance was here really on the day, and with the wild back and forth from Jerome Powell's sort of speech rally, you know, sure, we closed up closer to the highs, but most volume was actually committed down here towards the lows. So it doesn't mean that the market must pull back. It doesn't guarantee that the market is going to crash. But once again, it would speak to lower odds probably of just massive continuation in the upward direction into the remainder of the week. I think it kind of speaks to consolidation, digestion of this move, but certainly not looking for any big sell side activities noted by the failure from the sellers at the lows of today's trading session. And the single prints, which you can see clear as day right here for those folks who are maybe not familiar with the term single prints, there they are, right? That's the FOMC rally. Look in on Monday, no acceptance to the lows. Look in on today's session with all that big momentum, no acceptance, closing all the way down to the lows. And of course, we're up here. One thing that I would point out about the profile for tomorrow's session specifically is that there's plenty of excess at the lows and highs, but notice that the excess at the highs was put in M period, so that does technically leave us with a spike. Spike rules will be in place. Spike rules, for those who don't know, very briefly, if we open in this range, we're getting acceptance of these higher prices. You learn something when you break the prior high of day. Very rudimentary technicals, right? You break a prior high, you expect higher, or you'll learn something underneath the base of the spike, which in this case, you wouldn't necessarily see in a candlestick chart. That level in the ES is going to be 4176. 4176. Currently, we are opening underneath the spike, and that would be a rejection of these higher prices. So once again, that would speak to not improving the odds of just big continuation in the upward direction, saying, hey, cool it up here with the buying. Like, I get it. Sellers failed, but it's also not a buying frenzy. Like, take it easy for just a little bit. So market profile today, super informative with that point of control lower, with the value area lower, and spike rules being in place. With all of that said, I do want to point out as well, if we go on over to, let's go to the trade tab, and we'll move on over to the SPX. I was looking at this earlier. Another dynamic that's in play here for the market is the fact that we're starting to see some evidence of gamma squeeze, and that's evident right here. If you take a look at the call sizzle, which is at 9.5 versus the put sizzle, which is at 6.13, you could clearly make the assessment that, yes, there's more call buying than put buying. And if we think about what that means for market makers, right? Market makers are always on the opposite side of that trade. So if you go out and you buy one call, the market maker has to then sell you one call, which means they are net negative 100 shares. In this case, you can't literally trade shares of SPX, but you're negative 100 units per contract of SPX. So therefore, what do they have to go out to do to neutralize their delta and make it even? They have to go out and they have to then go and either long an ES contract, which is the S&P 500 futures. They have to buy 100 shares of the S&P 500 SPY, right? They've got to do something to neutralize their delta, which ultimately leads to increased buying activity. So you get this gamma squeeze spiral that's also adding into the mix of this rally back up towards the highs. Once again, it's not indicative of new money buyers who are going to break this market out to new all-time highs. It's speaking to the fact that you've got some sort of, I don't want to get too tinfoil hattish, but artificial buying as well, stepping in and supporting the market move higher. So with all of that said, let's move on over to our sectors and take a look at what's going on from this perspective. If we look at weekly change so far, notice that the energy sector is at the top of the list, up 2.68%. Not really a great look there, noting that energy is D for defensive, but followed up by the XLK, XLC, and XLF, all risk-on sectors. At the bottom of the barrel, the only red sector is the XLP for consumer staples, which is a more risk-off look there, so not overly concerned with the energy sector being at the highs. If we take a look through the structural charts really briefly, big perk up here, but nonetheless still stuck sideways towards the midpoint of this overall range. I'm not concerned with energy perking up here. Does not seem to be a big risk-off type move happening in the market. XLK, notice that we've rebounded off of these lows. We found support at the prior high here. Very mild pullback from Monday, so once again speaks to odds of sideways consolidation or further bullish actions, not so much expecting a big nasty pullback at this point in time. XLC, same idea, looks into the gap from the Meta earnings, looks into it, opens in it, and now we've rallied and closed back inside of the 2 days of consolidation from Thursday and Friday of last week. Once again, treat this as if there's no structure here. The sellers not making anything impressive happening, even off of a higher high, right? We weren't looking for sellers to drive this back to zero. We were looking for a reasonable pullback, and they weren't even able to do something like that. It's also indicative of folks not really willing to take profits up here. They want to hold on. If there was some profit taking, you would see that pullback. It simply was not the case. So folks want to remain long, and they do not want to get short. That's the evidence that I'm seeing so far in the price action. XLF going to be a similar idea. Nice healthy consolidation here above 36, no issues. XLU continuing to just lag the market, not really doing anything all that impressive. Fine. XLB materials also fine, holding up above that 82 zone, which is perfect. You want to see this bull flag sort of cup and handle look continue to unfold, and then a break here. It's been consolidating for long enough, which is why we're sort of talking about it a little bit more in depth. Unfortunately, it's a lightweight sector, so it's not going to have a whole lot of pull, but the structure does strike me as being healthy here in XLB. XLI, right back up towards the highs of this overall pattern. Remember that we're sort of watching this to turn into an ascending triangle now at this point in time. Long lower wick, closed at the highs, right back at 103. Once again, speaks to improved bullish odds, sellers not getting any traction down at the lows. XLY, consumer discretionary, hammer candle, right off the retest area at 148. I mean, thing of beauty. Break, retest, hammer candle now in play. Of course, you're looking for longs over these highs to revisit the highs from here. This does strike me as a more reasonable pullback that's unfolded, via this lower wick here at 148. So perfect, from a structural perspective. No concerns about this chart whatsoever. Next up is the real estate sector. Has much more to do with the wealth effect going sideways here, even as rates are actually increasing, strikes me as being okay. Not an issue for the market. XLV really impressed as well. We've talked about on the channel now ad nauseum the past 3-4 updates how yes, it's technically D for defensive. Yes, it's technically the heaviest weighted sector. We want to see it not giving the market a big excuse to move lower. It didn't on today's session, closing at the highs, although yes, underneath 133.50. Not the best look, but it's certainly not deteriorating or providing drag for the market. XLP, consumer staples, last but certainly not least, lagging the week so far, but we've got a nice hammer candle. We don't want this outperforming the market. It's still in this downtrend here. Could it revisit 74? Absolutely, that would be fine for our market. So not seeing any evidence either in the sectors that, hey, some big risk off type move is about to unfold. Same thing in the ratio grid. Look at the massive outperformance here in the XLK this week. Great look so far. New higher high was established. That is a risk on look if I've ever seen one. XLF, the structural chart, as we know, is consolidating sideways in that range. So if and when that breaks, I would expect the ratio grid here to perk up, but just starting to become a little bit cautious of this around the 50 SMA as it starts to slightly roll to the downside. XLV, we've talked about, again, how this is D for defensive. It's the one of the heavyweight sectors that can actually be underperforming, and we just described that on the structural chart. XLY looks great. Reasonable pullback here. We want to see this find a higher low, really anywhere over the 50 SMA at this point in time. So once again, this is a healthy look for our market. No major red flags going off for a risk off type move. And that's also evident in the bottom 4 risk off sectors, falling off of a cliff, falling off of a cliff, falling off of a cliff, falling off of a cliff finally as well in the real estate sector. So not overly concerned with really anything going on from a ratio perspective just yet. You would see those deteriorations and a shift to risk off before potentially that move actually unfolds. No one's positioning for it, right? Growth versus value continuing to outperform here. Strong opportunity for sideways, was not really impacted today by the not FOMC, but Jerome Powell's speech. So this continues to be a bullish data point. Let's have a brief look at the dollar and see what's going on here. Dixie, strong opportunity for that lower high here. Remember, we're coming into the back test at 103.50. We are technically in an overall downtrend with continuous lower highs being formed, looking for that lower high again off of 103.50, and that should relieve some pressure on the market, meaning more upside around the corner. So keeping an eye on this, it does have the opportunity to get above if that break does happen and we go higher low. Of course, as we pointed out in the gold contract on Sunday, we would be concerned about an inverted head and shoulders, which of course would be bearish here for equities. But until it actually happens, not positioning early for anything of the sorts. Now, one concern is what's going on with the TNX, and I'm actually going to load up the TNX signal study because this is what had me concerned about the pullback on the weekly watch list update on Sunday, right? We actually did fire off that bearish cross signal here where the rate of change went back above zero. You can see that rates are going higher, but tech was oddly enough up today, right? We saw that massive outperformance in tech. It was the leader. If you look at the daily percent change, up 2.35%, behind energy, of course, which is kind of an outlier as of right now. But with rates up and tech up, I think we'll learn something about the market on tomorrow's session to see who's lying, because typically those two things do not go hand in hand. So on tomorrow's update of the midweek market update, stay tuned and see, kind of how the dust settles, so to speak, between these two trades. Just to make some general comments about the TNX, of course, we would want to see this find a lower high if we want to see rates come in and relieve pressure on tech. We want a lower high anywhere underneath roughly 3.88. So let's go ahead and throw that level on just so we can track it together into the coming weeks or months. 3.88, anything that, lower highs underneath, then the descending triangle, this pattern here, is still primarily in play, and we would look for a breakdown in the future at some point, which would be bullish for markets. Now, let's get on over to the Fed Watch tool. One interesting thing that we learned from Jerome Powell today, and here's the clip.
Still play the guitar, or you're still...
I do, yeah.
Your hair is awfully short for playing the guitar. Don't you need longer hair? Was your hair longer when you were younger?
Grayer. It's too gray, too. So.
Okay.
He plays the guitar, so who would have guessed? Anyways, we saw a little bit more friendly side of Jerome Powell at the meeting. He talked about goods deflation still. He talked about housing inflation coming lower in the second half of the year. So again, that would mean that we've still got about 4 or 5 months to go before we see that information and data tick lower. Services inflation still ticky. Everything that sticky, he still sort of reiterated everything he talked about on last Wednesday's FOMC meeting. But he talked about the jobs data specifically having more leeway to vary. He made mention of the JOLTS numbers not mattering so much anymore. Now, in terms of the tracker, we are still expecting another 75 basis point rate hike to get us to that terminal rate, or one step shy of that terminal rate at 475 to 500. Market is still pricing in, if we move on over to the probabilities tab, the 500 to 525 terminal rate. And with CPI next week, I think this will be the main thing to watch, right? With when the CPI numbers come out, how does this move? How do the probabilities shift? What does the market price in? That's where this will really make much more sense. So we'll leave it off at that for our S&P for now. Let's move back on over and round out the remainder of the broad market here. QQQ is up next. What do we see? Never made it close to the single prints, not even scratching at the top of the singles. Higher low formed beautifully off of 302.75, the prior high from here, right off of the gap close area. I mean, everything about this chart as well does strike me as being more bullish than bearish, closing inside the in and out bar. Very similar idea as to what we just discussed in the S&P, really watching for sideways into the remainder of the week, not really looking for big continuation. One thing that we should note, and I guess we'll do it here on the Qs, is that if we do just get massive upside continuation, the market should start to become more susceptible to liquidation break as longs get in at worse and worse and worse trade location. If they don't get paid, if the market's struggling to make higher highs, and you notice that intraday, just be mindful that the market could see all of those longs close out in a snap, and that's what causes liquidation break. We talked about it on the Sunday update as we were analyzing Friday's activity of last week. You can go back and watch that video if you'd like more info on that. IWM is up next. This chart also screaming bullish signs, closing the single prints, the only one to do so. But from a location perspective, just look at how much higher it is above the prior double top here. Break didn't even come in here for a retest, already starting to rebound higher. Long lower wick representing support through the single prints after that structure had been repaired. prepared, respecting the lower edge of the weekly expected move, being a risk-on indication for the market. This is extremely healthy in my opinion, and a break over 196 could keep markets elevated into the remainder of the week. So watching that in IWM. Let's do a quick fire round through the core list of companies. Apple's very simple. We're over the inside bar high, that little red bar here at 153. Bullish outcomes remain on the table over 153, looking for the break of 156.50 over time, and large target overhead at 163.75. Not a day trade, but just recognizing that there's some room to run overhead here in Apple. Falling underneath 153, it's a patience play until we get down towards this gap, noting that the momentum's fairly strong. Wouldn't want to be a short standing in front of a train here. Next up, we've got Netflix, really resilient. I would say if there's one word to describe this market right now, resilient is the word. I mean, look at this nasty rejection off of the double top. We actually broke down underneath the short level that we discussed in the morning update today. And, so gap fill reversal, we broke down, never made it to this level at 352.50, and again, rallied into the close. So all things considered, it seems as though buyers are being stubborn here in Netflix and not willing to close out of longs, and sellers are not stepping up as new money shorts. So once again, hard to say anything nasty about this chart. If we break down under 352.50, that must be the level now at this point in time. The 333 level comes into play. I wouldn't really be chasing longs here in Netflix, considering that upper wick from last Friday. Next up, we've got Tesla. Beautiful chart set up here. Hopefully you made it to this point in the video just because of how nice this setup is. I mean, 197.50, everybody and their sister can see this level. If we breach that, and again, on the hourly chart, looks clean. Let's see here. I mean, just look at the rejection stacking up. You've got lows, higher lows, higher lows, higher lows coming into it. The consolidation is tightening. 197.50. Everybody can see it. Everybody's expecting the breakout. Does that mean that it doesn't happen? I mean, you could be the contrarian and take that point of view, but if we crack that level, look left, there's some pretty serious range to travel through here up towards 227. Again, not making the argument that we go all the way here, but there's just some overhead room to run. So watching Tesla specifically tomorrow over 197.50. Let's have a look at Google. What's going on with Google releasing their sort of AI, what's it called, Bard, I believe, to compete with the Chat GPT Microsoft stuff. The AI tech race is just absolutely fascinating. That seems to be the market's main obsession into 2023, at least in the tech space. Notice the big rally here, threatening a move into the gap overhead. So watching 108.25, quite simply put, higher lows need to stay over 105.15 coming from the intraday level here. Here it is on the hourly chart. Zooming in, notice that consolidation and failure there. As soon as we recapture it, that needs to hold now for a higher low if this bullish pattern is going to continue to unfold. If the bears are going to take control, it's really tough to identify the bearish entry here. Maybe it's on the move back down towards 99.50 and then a lower high breakdown of that for a really sloppy kind of inverted head and shoulders. So bears don't really have it going on here in Google considering this momentum. Next up is Meta, continuing to stay sideways in the gap range from Thursday, Friday of last week. Let's have a look at the hourly chart so you can see where this level is coming from. Bullish consolidation remains above 188.75, looking for breakouts tomorrow over 195.70, and upper target is 201.80. Been a while since Meta's been trading in the 200s. Anyways, that's your upside move. Anything that falls underneath 188.75, it's all about the gap underneath us. So one step at a time. If you're a seller, be patient. Next up, NVIDIA. This is another one of those stocks that's going to become difficult to chase to the upside. Liquidation break here is, should be the first thought on your mind, noting that we've made a higher high. Sure, we got the breakout here, looking for continuation, but again, use a stop loss. Be prepared for that liquidation break. Overall, the target on the upside is closing this gap, 225.50 up towards 230.65. That could easily happen tomorrow, and then we consolidate and pull back. You can see a developing pattern, very minor pullbacks, break, very minor pullbacks, break, very minor pullbacks, break. When and if we get to this next target, certainly expect some slowdown in NVIDIA. Could a deeper pullback be around the corner? Absolutely. Once again, be mindful of that liquidation break. That's the main thing that I need you to have on top of mind. Manage your risk as you're buying higher highs. Ideally in uptrends, we know this, we talk about it on the channel all the time, you're buying a higher low or you're buying an equal high breakout. You really don't want to be chasing the higher high breakouts. Anyways, Softy is up next. Big break on Microsoft as well with all of the AI stuff that we were just mentioning. Right up to our prior level. Notice here, thin structure from the breakdown. So if this has the fundamental catalyst behind it, if it continues to stay in the headlines with their whole release of the Bing GPT integration today or whatever, if this stuff continues to be top of mind for the market and AI is like the next focus, I think it could move through this structure sooner rather than later. The setup is bullish. We gapped green over red today, so maybe watch for some simmering down, but if we can put in a tight flag up here, the next break should be interesting into 279. Next up is Amazon. what's going on with the mini beast, noting that we did get a beautiful pullback. So this actually did give us a deeper pullback. Notice that from here to here, we're talking about a significant range, almost 15 points, right? So we came into the back test of the flag breakout. We did form a hammer candle on today's session. So overall, just watching for a long over 103.10. From there, through the thin structure, targets 108. So Amazon is definitely a player for longs, and this would be more acceptable, right? There's been more give and take here. There's some give, and then there's some take. There's some give, and then there's some take. Could we see the next cycle of give? Absolutely here inside of Amazon. I've got 2 trade ideas for tomorrow's session specifically for you. So if you made it to the end, congratulations. Here you go. BA, Boeing, continuing to be on an absolute tear, coming into the top of its balance range right here, watching for potential breaks over these highs at, let's just call it 215, 215 for round number's sake. If that does take place, looking to double this range overall. And you can see we traveled that range on today's session. Basically, you'd be looking for targets, let's say closer to 225. 225 would be your target, about a 10-point move inside of BA. It's a long setup here. Next up, we've got ETSY, ETSY, and loving what's going on here with the break and retest. You can see clear as day. We have this push, higher low on like a weekly time frame chart. You've got lows, higher lows, call it an inverted H pattern, whatever. We gap and go, and now we've got a hammer candle that repairs the structure, tags up at the breakout point, prior resistance, newfound support, hammer candle forms. If we can take out that high, looking for higher and continuation to the upside here in ETSY. That's what I've got for you in today's session. Once again, barring some of these individualized stock trade ideas, let's go back to the S&P and once again reiterate, we're not expecting massive continuation. There are some signs of slowdown. Think about the volume profile on the market profile we just discussed, point of control moving lower. We're not really seeing screaming bullish market internals, but the sellers are just non-existent in this market. If the S&P goes sideways, it may be difficult to find continuation in some of the setups that we just talked about, although the structure is there per se. That's going to wrap it up for today. Tune in tomorrow for the midweek market update. Tune in tomorrow morning for the pre-market prep even as well. And with all of that said, I wish you all a green trading week.